Hello, and today we'll be discussing the discounted cash flow model. You can see in front of you that I've opened up Excel, and we've already created a framework that we'll be discussing today. You can see columns B through H is really T1 through T7. Those are just representing time periods, so it could be monthly, it could be annually. For today's sake, we'll discuss it as if it's an annual period. You can see right below that we have the growth as a percentage. One of the biggest questions I get for discounted cash flow models is how long or how far out do I have to project? And the answer is it depends. And really what you're trying to do with a discounted cash flow model is trying to get to a point where the operations have leveled off to a long-term normalized growth rate. And so in this case, I've shown 7 years. Some discounted cash flow models can go down to 3. I would say 5 is probably the most often what I see, but it really depends on the client and the operations. And so in row 6 we have free cash flow. Free cash flow can really pertain to a lot of different things. It can pertain to free cash flow to equity, to invested capital, or to a specific project. And so really what you're trying to do is the cash flow that you're trying to determine the value for. The mid-year convention, we'll discuss this a little further, but the mid-year convention really just depends on how often you'll get those cash flows. And so if those cash flows come evenly over the period that you're capturing, a mid-year convention is the most appropriate. If those cash flows come at the year end, then you can go to a year-end convention. You could even go to a quarter convention. It just really depends on the seasonality of the company and when that you expect those cash flows. In this model that we have in front of us, I have built in both a year-end convention and a mid-year convention. We'll show the differences as we go through the model. The discount factor, obviously we're going to present value those cash flows to today, so we'll walk through that formula, and then after that it's just the formula to calculate the present value of those cash flows, summation of those cash flows for a discrete period, and then we'll move down to the terminal value, determining what the final year cash flow is, and then dividing that by the capitalization rate to get to your terminal value. The discount factor will be applied just so that we can bring that terminal value back to today. So the present value of the terminal value plus the discrete period cash flows equals the concluded value of the company. One other thing that I want to point out in our framework is if you go down a little bit, you can see we have a box for calculations only. That gives us the sensitivity that to go between mid-year and year-end. And obviously if you built in a quarter convention, you could do that right there too. In addition, a discount rate and a long-term growth rate. Those are the two major assumptions that you want to do some sensitivity analysis around. Obviously, if you work in Excel a lot, you realize that it's always harder to update a model if you actually put the numbers in the formula. So that way we actually set it to a cell so that it makes the sensitivity analysis and any other changes to the model a little easier going forward. At this time, I would recommend you go ahead and hit pause on the presentation and build the framework so that as we build this going forward, you can do it right along with me. Okay, hopefully you have the framework in front of you. Now let's go ahead and go forward. So one thing I pointed out is the mid-year convention. One thing I did want to show is we did build a formula in here, and you can see it's just a simple if statement that basically if my list says mid-year, then I want 0.5, and if it's a year end, then I want 1. So if you go down below, you can see that if we change our mid-year to year end, up here, my convention not only changes to year-end convention, but then that number went from 0.5 to 1. And moving out, it goes to 1 all the way up to 7 instead of 0.5 to 6.5. We'll show how that affects the value in a little bit. But for now, let's change that back to mid-year convention. So for the discount factor, the formula for discount factor is 1 divided by, open parentheses, 1 plus, and we're going to do 1 plus the discount rate. Now in this situation, since I want to keep that cell, the discount rate all the way through, we're going to go and lock in that cell. So we're going to put dollar signs in front of the B and the 29 so that doesn't move with us as we copy that formula across. And then we want to raise that to the power of time. And so the time here is 0.5 because we are at a mid-year convention. I don't want to lock that cell because I want it to move along with us. So what I want to do is once I do that, you can see the formula there, and you can see my discount factor is now 1. And the reason why is because as of right now, we don't have a discount rate down below. At this time, if I hit Control-C and just copy that formula across, you can see that I have 1 in every period. So since we're here and we're talking about the discount factor, let's talk a little bit about the discount rate. In this presentation, I'm not going to go too in-depth on that discount rate, but really the discount rate is the risk and the return that's expected from these cash flows. And so it really would range from anywhere from a risk-free rate to even a startup company that could have a discount rate in excess of 60%. So in this situation, what I can do is I can say that we're trying to value the equity of a company. And so when you actually do the free cash flow is to equity, so this is the amounts that are available for dividends per se, or capital appreciation. And then when you come down, when you change that discount rate, when you put in 25%. We can always have all kinds of theoretical discussions on if discount rates of 25% is right for the equity, but in this situation, we're going to say it's appropriate. And you can see that as soon as I do that, my discount factor reduces year over year, and it's really just saying that I should be getting a 25% return on my investment. So the present value is then just that cash flow that I'm expecting times that discount factor. We're going to go and just format that real quick. And so what that tells me is if I'm willing to invest $894,000 today, and I expect a 25% return on that money, that I'd get $1 million in 6 months from now. So we want to take that formula and just pull it all the way across. And then coming down to the sum of the present values, obviously if I'm making an investment, and this investment's over 7 years, I would get all these cash flows. And so then I can sum all of those cash flows. And when I do that, that tells me that if I was expecting that stream of cash flow over the next 7 years, I'd be willing to pay $7.9 million for those cash flows if the risk and the return is based on 25%. All right, so there's the discrete period. That's just a simple present value, time value of money calculation. Now what I have to say is from year 8 into perpetuity, we have to calculate the terminal value calculation. So the simplest way to do that is if we take the final year cash flow. There's a model out there called the Gordon growth model, and this is what we're built today. And then a long-term growth. If you remember down below, we had a formula down there, or we had a long-term growth rate. So we're going to say it's 3%. And again, there's some subjectivity there, some professional judgment, but 3% really is about an inflationary and GDP growth number. And so it can range from 3 to 6, but I would say that 3% is always a conservative number. So right here, we're going to take that $4 million and we're going to grow it 3%. We're going to sum those two to get 4.120. And so really what we've done there is we've said after we've grown 6.7% in the final year, we're going to grow 3% that year forward. So starting with T8, we're going to grow 3% and go forward. And so then there's the capitalization rate. Really what the Gordon growth model says is if you take your discount rate and you subtract out your long-term growth, you get what's called a capitalization rate. And so in this situation, we have a 22% discount rate, or capitalization rate. And then if we take that next year cash flow and divide it by 22%, that is our terminal value. So what that tells me is if we expect to get $4 million every year from now into perpetuity, and that $4 million grows 3% every year from now until perpetuity, or from year 8 to perpetuity, we'd be willing to spend $18 million for that cash flow into perpetuity. Now, obviously, we're out in year 7, so we want to go and bring that back to today. So our discount factor is actually the same that we use in T8 or T7 above, so 0.2345. So again, if we just take that 18 million and multiply it by our 0.2345, we get the present value of that terminal value. All right, so if I'm in year 8 and I'm looking at those cash flows, if I bring those back to today, I'm willing to spend $4.3 million on those cash flows as of today, because basically I won't get anything for the first 7 years, and then for year 8 into perpetuity, I'd get $4 million that it's growing at a rate of 3%. So obviously the concluded value of the company would then be my present value of the discrete period, so the first 7 years, and then I add the terminal value of $4.3 million. So that tells me the concluded value of the company is $12.3 million as of today. Hopefully you find that helpful. Feel free to send me any emails if you have any questions or would like to discuss more of the nuances of the discounted cash flow. Otherwise, feel free to continue to follow my blog, and we'll continue to go through some of the more in-depth conversations on discount factors, discount rates, free cash flow, and everything else valuation related. Thank you, and have a good day.